Thanks, Larry. Appreciate the opportunity to be here with everybody and kind of talk a little bit about the second quarter. It's a good quarter for us. I mean, we obviously had some strong recovery in the United States, a little bit more mix, obviously, is slower in the international markets. But new innovation, demand for new innovation, and really solid commercial execution, particularly in the United States, really drove significant growth over 19 and obviously growth over last year. We reported a lot of the growth against 19, principally because I think it gives a little bit more sound view of what's really going on. The kind of core behind all that was, of course, the PCIOL business in the U.S. and contact lenses. Those two businesses, which are core to us, had very good quarters. So Vivity, we've talked a little bit about, over some time, is a new advanced technology lens for us in the last year or so. It has been its launch has turned out to be largely incremental to the PanOptix product. So our shares continue to grow. There's a little bit of cannibalization, not a lot. And I think what we're seeing is some new patients coming into advanced technology lenses that maybe were in a toric monofocal before, but now want the advantage of a multifocality experience. So I think that's been positive, and our share continues to do well. Our penetration in this category, again, is slightly up from what it has been historically. Maybe equally interesting, I think our P1, our Precision One, which is our kind of leading brand for new and switch fit lenses, has driven some contact lens share growth around the world. It certainly was a big move for us in the United States. In the United States, we grew 17%-ish against what I loosely call it up kind of high single-digit number in the U.S. So again, it was a 8%-ish growth in the U.S., and we were probably almost double that, a little bit more than double that. So again, I think showing good growth against market, and market really solid for us in that first quarter. And then maybe a surprise for some, and it was certainly for us, was the equipment side of our business. Equipment, capital equipment, we have been a little bit pessimistic about, given the amount of money and that we thought would be available to hospitals this year. It has turned out to be much better than that, and I think across the board, both because we have some new equipment that I think is being well received, but also our core cataract footprint and our retina footprint with the Constellation and our Centurion products have been well received and continue to grow. So we've had really good results across the board. So directionally, with the way we see it, and when we talked a little bit about it on our call, was if you take it as a whole, we think the markets will recover to 2019 levels towards the end of this year. What's different, though, probably from what we've said in the past, is we think the U.S. is going to grow throughout. It's already growing over 19 and will continue to grow through the back half of the year. That will be offset by a slower growth internationally as you see some markets continuing to struggle. Think about Australia, India, Japan, some of our other Eastern European markets. But Europe coming back nicely, China, pretty good place. So a bit of a mix of balance, making international probably back to 2019 levels sometime early next year. So that mix will get us back to 19 towards the end of the year, and normalizing markets, if you call that normalizing. But that's been the view that we have, and I think we still feel that way about it. So directionally on that, we obviously made a change to guidance. Tim could talk a little bit about that as we go through this. But on a full year net sales basis, we see 8 to 8.2 and core operating margin kind of around 17.5 with an EPS somewhere in the $2 to $2.10 range. So I'll leave it at that, Larry, and then we can just jump into questions.
No, that's a great overview. I'm just curious, you guys reported relatively late in the quarter, so you had an advantage of seeing kind of how COVID's been playing out. It's only been a few weeks, but we all see what's going on with the Delta variant. I mean, any change to your view? You assume the U.S. market will continue to grow, above the 2019 level in the second half of the year. You're a little bit more insulated than some companies that have a lot of inpatient procedures because you're mostly ASCs and consumer. I'm just curious if qualitatively you can talk about trends you're seeing and how that might be different from what you were, assumed in the guidance.
Well, I think we're still, very much where we said we were, which was, as I just articulated, kind of back to 19 towards the end of the year with a mix, slow international and U.S. still growing over 19. So the magnitude of that we'll have to see, that'll play out. But I think directionally that's still the right answer. I think as we look at our business, I think you said it correctly, our surgical business, we're not going to see in the surgical business the same kind of shutdown we saw in April, May of 2020. I mean, that was a very dramatic, everybody stopped surgery, and it really didn't make a ton of sense because most of those beds aren't available for COVID use anyway. And so I think as we've kind of moved through this, there's, the surgeons and the staff have accommodated for, safety protocols. The surgical procedures are roughly staying, where we think they're close to capacity. And I do think that that will stay relatively stable because it's largely in the United States and ASC. Outside the U.S., that could be a bigger problem because, again, it's hospital-based. They're competing with other procedures. Again, I think that's partly why we believe there'll be a slower recovery internationally because, again, site of care will make a big difference, and kind of ownership of the facility matters a lot as well in terms of motivation to move staff through and to get surgeries done. That's going to be that's different market to market. So that's probably how we see that bit. And then on the vision care side, largely I kind of tend to believe it's a lot more about foot traffic and patients' willingness to go into particularly chain optometry, which is still 30 to 40% of the market, depending on where you are. Some markets it's higher than that. But where it is, it tends to be in malls and in places where COVID can have an effect on foot traffic, and that recollection, oh yeah, I need to go do that. Let me go make an appointment, or let me just go and look for some glasses and maybe I'll schedule an appointment. So, and I think because of that, the optometry community is largely willing to kind of delay refits or re-examination of contact lens patients, happy to kind of renew a prescription and say, hey, why don't you come? Let me handle some other patients that are probably a different economic proposition for me, and we'll just keep going with the lenses. So I think the lens business never dove as deep as surgical did, and it also has been relatively robust coming back. So I think we think it'll hang in there a little bit better, than some.
It's good to hear. I wanted to move, and there's some background noise, and I'm trying to figure out where it might be coming from. But maybe if we mute ourselves when we're not talking, it'll help. But just maybe a couple questions for Tim. Tim, you raised the 2021 guidance on the Q2 call. You didn't provide a lot of color on Q3 and Q4 cadence. How are you thinking about seasonality? And then I have a question maybe on 2022, just kind of puts and takes. Obviously you're not guiding now, but any puts and takes you would highlight for next year.
Yeah, I think in the guidance we looked at historical seasonality. So again, if you look at the 2019 profile, I think that's a pretty good profile as you're thinking about 2021. In Q3, we take into account vacation season in Europe, in particular, U.S. You get back to school campaigns. Q4, you get hospitals flushing budgets on equipment and so forth. So we don't really see anything structurally changing in that, and we've incorporated that in the guidance that we gave. As you think about 2022, we got a lot of launches coming out in the back half of this year and early part of next year, so that should provide a nice tailwind for us. I think as far as new product launches will be a key, similar to what we saw this year. Inflation is something we are keeping an eye on. We're seeing it in commodity prices. If you think about resins, what have you, we're seeing it in labor on the manufacturing side. So, we mitigated a lot of that in Q2. We're expecting to see some pressure in the second half of this year, and we baked that into our guidance. We'll keep monitoring it, but I would expect that to be a bit of a headwind as you think about 2022.
That's helpful. I wanted to move on to the financial goals that you guys gave at the Capital Markets Day earlier this year. Let's just start with the revenue and then do the margins. So you guys had put a goal out there of $10 billion in revenue, and that implies a CAGR about 5 to 6% per year. So David, how should we think about the cadence and the growth drivers to that $10 billion goal? Which I think, correct me if I'm wrong, I think that was 2025 or 2024. So you're on mute, David.
Thank you. I'm trying to lower the noise there. I think it was 2025 was the number, and it is 10 billion. Look, it's relatively consistent. I think what we see is that the markets should get back to normal growth, and that we aspire to grow slightly above markets. And we've got a mix of products that we've talked historically about. The turnaround for Alcon was always going to be about getting product flow and therefore revenue growth, and that revenue growth had to be in excess of what is relatively large. And I would say kind of slow growing base. So remember that we have, a lot of consumables business in surgical, which is always going to grow roughly at about the surgical volume rate. So let's call that historically 4%. And we've got a large, reusable lens business that's, was flat. That market was been flat to slightly declining for a while. We've got a contact lens care business, which was a declining market by 5%. So there was enough stuff that we were trying to renovate, if you will, and kind of rejuvenate in the product line, that the growth ideas had to be big enough that we could get growth over market. And I think that's what we've seen now. Our going out strategy was, invest and keep the hammer down on investing in R&D and new product flow, because our thesis has been if we can grow mid-single digits, we can get to the bottom line, because we made some fairly good choices about moving the costs around, and we're trying to get from kind of the back office costs into support launches and R&D, those investments being our primary ideas for how we grow. But if we do that and roughly keep that in the inflationary zones, then I think our revenue growth will give us the kind of earnings growth we need. But the trajectory is pretty steady, and it's pretty much a little bit faster than market growth. So as you're modeling that, you're thinking about that. The way we think about it is just, every year we see the market as it comes back, and how can we grow a little bit faster than that? Larry, you're on.
I'm on mute. Why don't we pull up the first polling question, Luke? And I'll read that off, and then because there's a little bit of a delay, then I'll ask David a follow-up question. So, Luke, are we ready? All right. So, at its Capital Markets Day in March, Alcon set a target of $10 billion in revenue in 2025 from the $8.2 billion revenue, 8 to 8.2 billion. I'm sorry, revenue guidance in 2021. That implies a CAGR of 5.4% by our math. Do you think the company's more likely to overachieve or underachieve this goal? A, overachieve. B, underachieve. C, the $10 billion seems about right. D, not sure. And David, while people are filling that out, let me ask you, a question about that. Your surgical division has outpaced your vision care business since the spin. Do you expect that to continue?
No, there's really, the surgical business had the benefit of product flow from the very beginning. We had a little bit more of a run-in when we first got here. We started work on the surgical business first, and frankly, the vision care business, the run-in requires manufacturing investment to support it. That just takes longer to get in place. And so, if you decide, you want to build new products in vision care, you've got to develop the product. Then you've got to decide that you're going to invest the money in the capital. And, if you think about it in broad terms, it's about $50 million a machine. They make about 50 to 70 million units, per machine. And so you can do the math on what you've got to believe in terms of share and growth to want to go after this market in a meaningful way. It's not it's a very good barrier to entry, but it's also something you have to be deliberate about and be right about, over a long stretch of time. And so I think we were a lot more deliberate in vision care because it was a big investment and because we felt like we needed to be certain. And surgical gave us a nice lift in the beginning. I think what you're seeing now, in the United States, for example, and I think you're going to see it around the world, is we're outpacing the market quite substantially because we're in the fastest growing parts of the market, and that's kind of lifting the bits that I talked about earlier. So, dailies, SiHy is the fastest growing category. Daily SiHy grows faster than that. Daily SiHy toric, fastest growing segment by a lot. These are all the places we've just launched products and will continue to build next year. And then if you think about what I was saying with the kind of base business, our AR optics business is a big business. At one time, it was the best, monthly lens out there, but that was 20 years ago. Now we've got the benefit of new technology and new manufacturing. We can come back to that and look at a $6 billion market that we have a mid-teen share in and do better than that. We have a low 30s share in the dailies business. We should aspire to have much higher share than we have in the reusable business. And so I think, that is the kind of thing that will kind of help us build, above market growth in vision care kind of through the plan. So I think that vision care, our objective last year was to grow. When we first spun out, we were growing slower than market. Then we were trying to get to let's grow at the market. And then this year we've been saying that we can grow faster than the market. And I think that's what we plan to do going forward.
Okay, that's super helpful. Let's see the results of the polling question. Luke? All right, 10 billion seems about right. 60% overachieved. David, pretty optimistic group here. Any reaction?
Well, I hope they're right.
All right.
Look, I think when we set guidance out on this one, remember we were doing it with the backdrop of COVID, and again, I think baselining will matter a lot when you get to these. When you're trying to get to 10 billion in 25, what you're trying to figure out is, what's the starting point? I think if the starting point, if this COVID resolves sooner, I think I feel really good about where we're going. If it drags out into next year, I think we could struggle, but I think there is real variability around this, and so I think this is probably a little on the optimistic side, but I'm glad to see people, understand our markets and understand what we're trying to do.
Okay. All right. Let's move on to the margins, because that was the other target you gave, 23 to 24% by 2025, and that's about 600 basis points improvement from the 17.5 you're guiding to this year. So I wanted to ask, let's maybe open the polling question up, but before we get there, maybe Tim, maybe if you could just elaborate a little bit more on your comments about inflation. Is there anything you can help us with, raw material costs, anything that help people understand what that headwind might look like for you? I mean, I just feel compelled to ask a follow-up question on that.
Yeah, again, we have a significant manufacturing presence, and a lot of our employees are in the manufacturing arena. So, we would expect, particularly in the U.S., we're seeing labor increases, wage increases. So that's something that we're keeping an eye on and monitoring. I think the best, if you're looking to kind of frame it up, as we said on the Q2 call, in the second half, we expect a point of margin pressure. And half of that is the investments in our new product launches. And roughly the other half is a combination of inflation that's not being offset, along with a little bit of mix. So, call it a half a point on $4 billion of revenue, or 4.1 if you pick the midpoint. That's kind of, you can annualize that, and that's the kind of pressure that we're seeing. Some of that will be offset. Again, we'll have to wait and see how next year plays out, but we'll give you guys more color on that at the beginning of the year.
Got it. And currency, Tim, has been a tailwind or a headwind this year? I can't remember on March. Has it been a tailwind?
It's been a little bit of a tailwind.
Yeah. Okay. All right. So the second question, Luke, you ready? Okay. At its Capital Markets Day in March, Alcon set a goal of approaching mid 20% core operating margin, which they defined as 23 to 24% by 2025. Alcon expects 17.5% in 2021, which implies a 600 basis point improvement over the next 4 years. Do you think the 2025 goal is realistic? Yes, no, maybe, but it seems aggressive. D, not sure. So we'll let people respond to that. And I'm just curious. I asked about this on the call. The surgical margin, got up to 27% in the second quarter. The vision is down at 16. What's assumed, Tim, in the 2025 outlook for each? The thing is, I believe you guys have said in the past, you think each division ultimately has similar margins. I don't know if that's an accurate statement, but if that's true, it bodes well if you can get vision care up to where surgical is.
Yeah, again, I would point folks back to the slide that we showed at Capital Markets Day, and you're right. There's a big difference now, and we anticipate those margins for surgical and vision care kind of converging over the course of the plan. We're obviously seeing some near-term pressure in vision care driven by the line installations that we talked about on a few occasions, but we would expect those margins to converge, and that profile, we still feel good about.
Okay, that's interesting. Luke, do we have the results yet? All right, you ready? Drum roll. All right. Maybe, but it seems aggressive. Yes. No. So David, generally optimistic. Any reaction?
Well, that's probably, I think that's probably right. I think we are, this plan and our thesis depends on revenue leverage. And I think that's really the thing. We are going to get some gross margin lift in the back part of this plan as the gross margins mature in the vision care business. But really, if we hit I think it probably goes to the first question, which was if we can do the mid-single digit revenue and you're comfortable with that, then I feel like we're in a good place to get into these ranges. So, again, that's been our thesis. I think we still feel good with it. It's obviously a big change in some ways, trajectory-wise, but I think it's also we have, I think people will know this. We've spent a lot of money in these first going out couple of years, getting ourselves into position to do just this. So, this is kind of consistent with what we've said from the start. And if anything, we've done a little better than we said from the start because we've in essence almost absorbed this whole COVID thing and still getting to what we said in when we spun out in 19.
The other thing I would add is, again, we feel comfortable with the guidance we gave at Capital Markets Day. Certainly a lot of work to do between here and there on the margin progression. But, at some point when we get closer to that, if margins are running hotter, we will face a decision point of saying, hey, look, do we want another point of margin improvement as an example? Or do we want to invest that to try to drive another point of sustainable, profitable revenue growth? So, our view is at that stage, you're going to create more value by growing higher than mid-single digits if we think there's an opportunity there versus grabbing another point of margin. But again, there's a lot of work to get from here to there.
Tim, it's kind of an obvious question, the 600 basis points, 150 basis points a year. Does the inflationary pressure change kind of the cadence that you talked about where we should think about it a little bit more back-end loaded?
It's not going to be exactly linear, but, we're going to see, sequential improvement. Again, given what we see today, we feel comfortable with that. If that changes, we'll obviously update folks, but, we're working the inflationary pressures as we see them. And we're just going to have to play it out.
Okay. We only have 5 minutes left. Actually, I wanted to ask one on LASIK. That David, refractive growth has been really strong. And I think you called out how much it contributed to the growth in the second quarter in the equipment business. How sustainable do you think this kind of rejuvenation is, if you will, in LASIK around the world?
Well, it's a good question. We did say, what we, contributed. We had a very good quarter in equipment. We were up 23% over 2019, which is, it's an unusual number. And I wouldn't expect that to be repeated. I think we were surprised half that growth came from our core business and half came from refractive. But we are the world leader in refractive surgery. And so as refractive has been a positive trend and really picked up, our refractive business was up 90% over 2019. So we had a kind of a stunning number there for us. we had a different view of the world when we went into it. You'll probably remember, Larry, we talked about, an expectation on capital and on capital equipment and on refractive that would be a lot more like the 08, 09, scenario that we had where we were up at 1.5 million procedures and it crashed to like 700 over the course of 200,000. That just didn't happen. It's gone the opposite way. And I think it's been, people have time, people have money. I think there is a real thing about this, these Zoom meetings where people are looking at, at our glasses and going, do I really need to wear these or should I go get LASIK? And the LASIK surgeons have responded by staying very busy, but also buying new equipment to expand the footprint. We've benefited a lot from that because candidly, LASIK, is still the world's most successful procedure in eye care. I mean, it's a 99 point something crazy high in success rate, and it's a wonderfully, well-received procedure by almost everybody who does it. So it's exciting to see. I'm not of the mind that we're going to see these kinds of growths, and in fact, I think this could turn to a headwind for us for next year because the growth over 19 is so high. But I think there's probably some natural. It's pretty tough for me to believe we're going to grow on this number. However, I think it probably settles out over the long haul into a nice steady growth, and that's probably good for us. So that's how I see it, at least at this point.
So we've only got 3 minutes left. Two questions on innovation. Maybe we can get Ian involved here. And I apologize, Ian, didn't get you involved earlier. But the one, so presbyopia drops have gotten a lot of attention. Does that fit? What's your level of interest? And then robotics. It was on the slide deck at Capital Markets Day more than once, but I haven't heard Alcon really articulate what role robotics have in ophthalmology. So David, you were Ian. I'll give a jump ball there.
Sure. Ian, why don't you give it a go?
Sure. Look, I think we're watching the market closely for what's happening with presbyopia drops, and clearly staying close to that market because the whole presbyopia correction is such a big part of what we do across all the businesses, and so we're staying close to what's happening there and watching that closely. The robotics, clearly, as we go forward, we're thinking about how our technologies can work together, and as things progress over time, as we enable surgeons to just link up what they do right from the diagnostics all the way through to the end procedure, we're thinking hard about what we need to do in innovation there to really bring that to life. Maybe David, if you want to add to that.
Well, and that's the critical part of our equipment strategy. It really is robotics. I mean, we're already robotically involved. So I mean, most people probably know that we have an eye tracking mechanism for wave light to do refractive speed. So if your eye moves in any way, the laser is following it, which is completely robotic. We have robotic arms on all of our equipment that are doing things in an automated way that takes surgical error out of play, and some of it is. And as that technology converges, I think what you're going to see is an increasing use of femtosecond lasers to do the capsulorhexis, to do the incisions, to do astigmatic correction, to do the real breakup of the cataract. And that will be driven by, as Ian says, the diagnostics done preoperatively. They'll be told to the computer. The robotics on the femto laser will do exactly that work. And almost immediately, we'll also look at how do we remove that cataract over time without necessarily with I'll call it modified surgical assistance. So a much lower tax on the surgeon and much more assisted surgery over the long haul. Really big deal. And last point, Larry, on the presbyopia drops. I went to the SCRS meeting. I don't know if you were probably there as well. There were 6 companies doing presbyopia drops. And so we're interested in all that, but it is interesting. There's a lot of activity around it. But these are, largely these are reworked products that are pilocarpine based or carbachol or something else that we know a little bit about. We make all this stuff now, so for us to get in this would not be a big stretch for us. But this is a pretty interesting market to try and figure out because we don't know whether there's a big market here or really quite a small one. And we're really trying to assess what is the market for these products really, what will it likely be, and again, that's where we're going to spend our time in the near term.
Okay, perfect. Well, I wish we had more time, but I really appreciate you guys being here. It was a good discussion, and hope the rest of the day goes well for you.